Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Dustin Miles. He is the founder of Momentum Multifamily, which is focused on educating and empowering multifamily real estate investors. He syndicated his first multifamily deal in 2014. He has raised over $1.6 million in equity. He has led 17 apartment deals totaling more than $330 million in value. He's raised over $100 million in equity across multifamily deals. He started investing passively in multifamily in 2012, and he got his start flipping houses and purchasing rental property. He is an early entrepreneur, launched a global online business selling gaming cards while in college. He is a co-host of Momentum Multifamily Meetup in Las Colinas. He is also serves on the board of Cancer Care Services and has raised over $10,000 for that charity in 2019. He also holds a mechanical engineering degree from UT Austin. And so, Dustin, welcome to The Wealth Flow.
Yeah, thank you for having me. Excited to be here.
Yeah, excited to have you and to dive into your story. I know you and I talked a while back, and after that, I definitely wanted to have you on the show. So looking forward to hearing about your story. If you could, though, what I like to do is really start with your background, where you grew up. I know that's going way back, but, and then what led you to real estate?
Yeah, appreciate that. So I'm from Fort Worth, Texas. I think we just became the 11th largest city in the country. But from here, grew up here, live here now. So I, grew up here, went off to school, moved for my first job from Austin to College Station. And if you're from Texas, that's not the typical move.
Right.
And then moved from College Station to San Francisco, which is, big change in, scenery and all that too. So, as far as real estate and all that, I guess I had real keen interest in real estate pretty early on as a kid. Might sound weird, but I just remember I'd ride my bike everywhere. I don't know. I guess that's what you did in the 80s, but
right.
But anyways, I rode my bike kind of all over Fort Worth, and I just remember, or if I was in the car, I just remember kind of wondering to myself, which this sounds weird as like an 8-year-old, but I'm like, who owns all these big buildings and all that? And I played soccer as a little kid, and fortunately still play today. But one of the kids that I played soccer with, his parents owned some of those large buildings. They own a lot of commercial property around town. They own a skyscraper in downtown Fort Worth. And so anyways, I played on the same soccer team as this kid. So I kind of, I watched him and his family pretty carefully. And I remember going to his house, his birthday party, as a kid. And I mean, they had a huge house. and all that. I'm like, oh, these guys, these people own some of that, large real estate and all that. And so, anyways, but I just always I think like a lot of people always had it in my head that you had to be ultra rich or ultra wealthy or a big company in order to participate. And then, fortunately that's not the case, these days. And so anyways, but yeah, that's kind of where the initial interest came from.
Awesome. And from that, that's neat that they owned you just happen to play on a team with somebody whose parents own big buildings downtown. I mean, it's just not the norm, but that's neat to have that insight and seeing that. But you got your actual start, I guess, with flipping homes and rental property.
Yeah, I sure did. Was trying to get into it 2006, 2007. Part of it was probably analysis paralysis and just kind of honestly, it was kind of a big jump and all that, at least for me at the time. And I'd hired some different mentors, and just to be honest, I didn't go well at all. And the mentors that we hired just, either would like just kind of disappear or whatever. And so I'm like, okay, if we hire anyone else, they need to have an office. And so I had found Lifestyles Unlimited. They were on the radio and they had an office. So, went to their thing, and so they teach people how to buy single family. But what was even more interesting to me was that they taught people how to buy apartments as well. And so I'm like, okay, this is feels like the right direction to kind of move in. So anyways, they helped me buy single family. And so I think I bought my first house like 2009, 2010. I can't remember exactly. But it took me a while to land that first house. They actually, I might have it around here somewhere, but I think it's over there. But I got an award for the most offers without landing a house. So I think I made 50 offers before I got an offer accepted. So anyways, but that's kind of how things started out for me.
Yeah, that's neat. I that's funny. I don't know how across the U.S. how prevalent Lifestyles Unlimited was or is, but certainly in San Antonio, I know they had an office, and that I'd seen. I think it was off 410, but I'd heard them on the radio as well. So I always wondered about that. So that group was, I guess it provided a little bit of a community as well to be able to bounce some of that stuff off.
Yeah, it did. There's a lot of large syndicators, basically all of the groups that, that are kind of in Texas kind of came from there, at some point. So I was, Brad Sumrock was a coach there. And then, all the Rockstar Capital guy came from there. The people that are in, San Antonio kind of came out of there too. So, and there's a lot of people in DFW that came out of there. So yeah, basically everyone kind of came from there. I mean, you gotta, they were the only game in town, and so they did a good job, and some, people were able to kind of start their own thing, from there. So
okay, and so you purchased your first house sometime around 2009, 2010. Was that one a long-term rental or was that a flip or?
Yeah, it was a long-term rental. Bought it. It was actually, it's a real nice house. It's a 4-3. It had like an in-law. It had two kind of master bedrooms. One was like more of a in-law suite type of thing. But super nice house. Had ceramic floors. You didn't have to worry about carpet and all that stuff. Bought it for $90,000. It was a foreclosure. It was 2,300 square feet. Rented, I don't remember exactly. I think it rented for like $1,300 or something like that at the time. So anyways, yeah, it was a good rental. I ended up selling it a number of years later. Trying to remember. I think I sold it. Yeah, I think I owned it for about 10 years. Sold it for 250, 270, something like that.
Okay.
So,
Yeah.
yeah.
Nice. And then from there, you did some more single family. How many more did you do before you took the leap into multifamily?
Yeah, ended up doing half a dozen. So there were a few, I did a few initial rentals and then a few flips. Especially the first one, I really was trying to make sure I wasn't looking for a home run or a grand slam. And that's kind of the philosophy I took into multifamily too. Especially when I was just trying to get a win. I was looking for a single or double, and so that's kind of that house fit that. Ended up doing a lot better than that, but that house fit that profile.
Nice. Okay. And then tell me, I guess, about your first multifamily. What did that look like from an investment standpoint? Were you a limited partner on that? And if you remember kind of some of the details of that deal.
Yeah. I was a LP. I was also a guarantor on the deal. I was friends with the guy. And so I asked him, I'm like, hey, cause I knew I wanted to, lead deals and sponsor deals and syndicate deals and all that stuff. And so I'm like, hey, can I be on, I was planning on putting in, $25K. And he was like, I asked him, I'm like, hey, can I be on the loan and all that? He's like, yeah, no problem. He's like, can you invest more though? And so ended up, putting in $50K, which, at the time, I mean, that was 2012. And I bet that's probably more than the down payment, I put on a house and all that. So at the time, that was the biggest, investment I had made.
Yeah.
At the time. So it was, I was kind of nervous writing that check. It was
For sure.
It's a lot of money. And then kind of, so not that I really helped or probably didn't even really learn a whole lot, but I went to, due diligence and all that. So kind of got to see how that worked. And then, for me, it was kind of doing a deal, but with training wheels, sort of.
Yeah.
And so I just got to see how the deal worked. I'm like, it's not that complicated. At least at the time it wasn't. And so I'm like, if he can do this, and he's, very smart guy, but I'm like, if he can do this, I can do this. So, so that actually was a big confidence builder, for me.
For sure. And where was that one located? And do you remember how many units it was?
Yep. 76 units, bought it for like 40 a door, no, 46 a door, which at the time was like it was a record. Built in like 80 or so. It was in Wiley, which is next to Plano, which has been, growing by leaps and bounds. It is across the street from an elementary school. It is in a really good little spot, honestly. Held it for, held it for, how long was that? 12 years. Yeah, held it for 12 years.
Oh, wow. Yeah.
And it was, I don't remember the multiple, but it was 5x plus, as far as the multiples. So
that's great.
Yeah, it helps when you're buying in 2012 too.
For sure. So, yeah. For 46 a door, you said that was a record then. And can you imagine? I mean, where things have gone from there?
Yeah. I mean, right now the market's not, as you probably know, the market's not, prices are down and all that. And that deal would right now probably go for 120 or so.
Yeah.
A door. So,
yep. That's pretty crazy. All right, so you got that one under your belt, and it was your biggest investment at the time. Sounds like it was That's a long hold, but I mean, 5x multiple, that's amazing. So,
Yeah.
great job on that. And then where did you do from there?
Yeah, made another LP deal. Just while I was, but I made the switch. So lifestyles, the kind of, so Brad Sumrock was the mentor there, and then that's kind of about when he split off from there to start his own group. So the person that was going to be the multifamily mentor, had, they did single family, not multifamily, and so I'm like, I want someone with more experience than me, and and was really wanted to coach to, I wanted to grow and wanted to learn. And so anyways, ended up following Brad over to his group, and then, made an LP deal, investment in the process, and then was, started learning over there, and then started making some offers, and landed my first deal over there in 2014.
Okay.
Mm-hmm.
And on that one, were you a general partner on that one or a limited partner still?
Yeah, I was the lead, kind of everything on it. It's interesting. People didn't, I don't like back then, way back when. No, they didn't really. I don't know. A lot of people didn't really partner up on stuff.
Hmm.
So, anyways, but I mean, I had a partner, but it was, he was very much kind of more of a passive, type partner, but basically kind of helped sign on the loan and all that.
Mhm.
So but yeah, that was my first deal. Asset manager, capital raiser, analyst, kind of, all 4 or 5 hats. So
Yeah. And where was that deal?
It's in Haltom City. So I live, part of what I wanted was I wanted something close if I could. I still had a full-time job at a defense contractor.
Hmm.
So I just didn't have all the time in the world, and wanted something close to where I could get by there frequently.
Right. Okay.
So yeah.
And how big was that one?
It was 109 doors. I think I mentioned, it's about 15 minutes from me, and I utilize third-party management there.
Okay.
Mm-hmm.
So you got another one down. And how did you find that one? Through a broker?
Yeah. Pretty much everything I've done's been through a broker. It was actually on LoopNet as well.
Right.
At the time, but yeah, it was through one of the larger brokerage shops in DFW.
Okay. And how on that one? I assume that you've sold that one since. How long did you hold it for, and kind of what did that look like?
Held it for about 5 years. It actually just sold again. They held it for about 5 years too.
Okay.
And then but yeah, held it for 5 years. It was close to it was about 2 point, I can't remember exactly. It was just under a 3x multiple.
Okay.
For that, I mean, cap rate compression helps, and all that too. But yeah, and it went, again, similar to the single family kind of mindset of, I wasn't looking for a grand slam, or I didn't want like a deep value add or anything like that. I want something I could go in, I could improve, upgrade some of the units, and maybe make some other improvements, and then, provide an attractive return for investors. So want something close by, want something not, frankly, not paying the rear. Yeah, there were some other people, friends of mine, that had bought in kind of, honestly, it was a rougher deals, rougher parts of town, but, they got it for a lot less. There was a lot more upside, but there's a lot of risk, there's no free lunch. And so if there's, it's deeper value add and more upside, there's more risk involved. And so that wasn't very interesting to me. So yeah, but it went fairly well. We did a cash out refi at year 2, and so investors were able to basically have all their money out of the deal after year 2.
That's great. Yeah.
And so yeah, had a lot of happy investors on that one. And kind of a fun fact is one of the LP investors, so she became a syndicator, and then she was an LP in that deal.
Mm-hmm.
And her and her investment group bought the deal. So
Oh, wow. Okay.
yeah,
Cool.
well, it was an easy sell for her because our distributions were, very consistent, very solid, 8 to 10%. And that's what, that was the sales pitch to our investors. She was like, look, I've been in this for 5 years. Look at, it's extremely consistent.
Yeah.
And so it was an easy pitch for her. And then another little fun fact is, so the guy that bought it from her, that's the second deal that he has bought that I have also owned prior.
Oh, wow.
So,
Yeah.
which is kind of funny.
Yeah.
So,
That's a little different.
yeah.
And so tell me a little bit about, and for the audience, just, so these aren't heavy, value adds, but what type of strategy did you have on this one? What are some of the improvements that you did make?
Interior renovations. So, this is a 69 product with a mansard roof. So the toilets were dated. So we did a water conservation program, and so we were able to save quite a bit on the water side from there. And then in terms of improvements and all that, it was mostly. We did do some appliances, but mainly flooring, two-tone paint, and like backsplash. So, it's interesting. The more you get into this, the more and you're like, wow, I only had like $3,000 per door in renovation budget, and we buy 2,000 product, and we have at least 10 to 15,000 a door, which is kind of interesting.
Yeah.
So you live and learn, but yeah, that's kind of what it looked like. We did end up, we had to do some things for insurance, like our rail height. I think our rail spacings were too wide, so we had to put an extra rail in there. We ended up, when we refied after year 2, because I'm a big believer of, if you think about it, so our tenants, we made a lot of money because they paid their rent. And so I'm like, so just inherently, at least for me, not, everybody doesn't have to do this or whatever, but like I felt that we kind of owed the asset and the property, want to take care of people and want them to, want people to, I've lived in apartments. My family has lived in apartments.
Mm-hmm.
And we just want to try and take care of people. So we, infused money, back into the property when we refied. So
nice. Okay.
Yeah.
So made some more improvements there. And so has everything that you've bought kind of been in the Dallas-Fort Worth area or MSA?
No. Yeah. So actually, I've bought some stuff here. I've purchased some stuff in Oklahoma before, bought a deal in Waco before. We have a portfolio right now in Houston, about 1,600 units down there.
Okay.
Mm-hmm.
So you've branched out. And tell me a little bit about what you've kind of learned throughout that journey. I mean, obviously, as you mentioned, just the renovation budget has certainly changed, but I'm sure there's some other things and lessons that you maybe have learned along the way.
Yeah, I think the longer, it depends on the type of loan that you have and all that too, but just a big fan of having plenty of cash, not to have cash just to have cash, but these are big properties and big buildings, and honestly, stuff happens.
Right.
If we have a storm that blows through, I mean, one of our, in Houston, we have our largest deal down there is 360 units, and it doesn't take a whole lot for us to spend $50K there.
Right.
I mean, you get some fence, you get some roof repairs or whatever. You're $50K pretty quick. And so just a big believer in having plenty of cash. I've purchased I have so many tools available to me right now that I didn't have when I first started. I would say kind of access to crime is something, I pay very close attention to, and just making sure that, we're in the right parts of town and all that. There was a deal, in Oklahoma that, I bought into that it it looked fine. I drove around, asked around, and honestly, I thought it looked like the area I kind of grew up in Fort Worth is what it looked like. I mean, it was, just kind of working class. A lot of the homes were like 1,500 square feet, like no bars on windows or anything like that. Just looked like, just a nice, clean neighborhood. But we got into that deal, and we struggled to be able to push rents or anything like that. There was gun activity and crime kind of. We didn't have as much at our property, but the property next door, we can't control our neighbors, right?
For sure. Yeah.
And once you're there, you can't control them. And so, really just the value and the, importance of location. I know in single family, they always say location, location, location. And I think that rings true, just as much for multifamily too. I mean, there's so I've done, started, did my first deal in 2014, done about 3,000 units total, and frankly, I could have a lot bigger portfolio than we have now, but just not willing to compromise on location at all. And it's just, there's already, operations can be challenging, especially the past few years been really challenging, and I don't want to add to that. And so I'm just not willing to compromise on the area. So I would say, have plenty of cash and pick a location you have strong conviction about and you feel really good about. That'll help kind of set you up for success. If you buy in, an area where there's a lot of bad debt, a lot of turnover, a lot of evictions, man, it can be very, very challenging.
Yeah, for sure. I think that's great advice. And so tell me a little bit about what you're looking at when you look at the crime statistics. Are there specific criteria that you're like, okay, if it goes above this or whatever, we're just not doing it?
Yes. I mean, you can look at it, depends on, for whatever reason, it doesn't show up in Fort Worth, but it does over in Dallas, and we use it in Houston quite a bit. But we have our portfolio in Houston, we just kind of know where to be. Right. But you can, I think it's Community Crime Map. You can just type that into Google, but so we look at that. So if you look at that for Houston, for instance, just because I know that really well. So if you look at it, a lot of the crime is kind of within Beltway 8. And that's just, part of it is zoning's a little wonky once you get within Beltway 8, and it's just a little more challenging, kind of more inner city-ish there. Or it can be. There's some really great parts of town too. But so we've chosen to be outside of Beltway. Once you get outside of Beltway, if you look at Community Crime Map, it's clean.
Yeah.
And so it's, I guess it's probably, I wish it was a little more of the engineer in me wants it to be a little more science than an art. But it's a little more of an art. I'd say, at this point, but Some other things just kind of you can look for, and this just gives you some decent indications of the area and all that. If you're talking to a regional manager, you can ask, hey, is this, are the courts backed up, in this area? Because that's a good indication of whether, it might be a more challenging area to operate in.
Yeah, makes sense.
So.
Have there been where have some of those been where it seems like you're having challenges with the courts, that kind of thing?
For the properties that we're in, we do have, I think some of it's because there's a lot of apartments in those areas, but I know we don't own in DFW right now, but there's some parts of some parts of Fort Worth, some parts of Arlington that have seen that tend to have the courts backed up. In Houston, especially during around COVID, or kind of right after COVID, because the problem with COVID was, some people got their rent paid for, and then when those dollars are shut off, I think people were like, "Hey, you're still paying, right?"
Yeah.
And so a lot of courts were back. Pretty much all the courts were backed up, kind of during COVID, right after COVID. I'd say there's the deals that we're in. We do have some judges that are a little more challenging than some others. So
Yeah.
I've never been very political, but I'm like, I'm starting to care about which judges being elected. So, but yeah, we've seen the courts backed up. Most of our portfolio is kind of Northeast Houston. We have seen the courts backed up there some. So.
Okay.
Mm-hmm.
Interesting. And then on some of the so tell me a little bit about kind of on some of your more recent deals, maybe some that you're about to or do. Are you targeting a specific hold period? And what's kind of your buy box look like from how old is the property? Or are you kind of agnostic on that? I mean, just I guess give me a little bit more of an idea as to what you're currently looking for.
Yeah. So in Houston, it's 90s and newer outside of Beltway 8. We want 150 units or more. Just below that is really challenging on payroll. We would look at something a little bit less than that, only if we happen to own nearby and we can like share staff or something like that. We might look at if it's like a really good deal. And then our preference is 2000 and newer, but we do have 193 product in Houston. And then and there's pockets of town that we prefer because we like to cluster things together. Right now we're kind of heavier kind of on the east side. We want to kind of, I guess, we want more on the west side and kind of the northwest side just to balance it out a little bit more. Just from we have found it's very helpful to have other properties nearby because we can share resources and we can get better deals on landscaping, better deals on valley trash, and just better deals on a few other things too. And then as far as our buy box in DFW, it's 1980s and newer, 150 units and up, just well located. We just want to make sure we're in good parts of town. So I hadn't mentioned this, but so in Houston, our portfolio, our brand there is the Henry. So we have 7 Henrys around Houston right now, and looking to continue to add to that. 2 of the deals are by the same builder. If you look at there's one deal that has more brick than the others, but if you look at the other 6, you would think they're all by the same builder. They all look very, very similar. And everything that we do is the same. We treat this business like a franchise. So all operations are the same, colors, uniforms, everything's the same. We want people that work for one property to be able to, go to our property, the next one over, and be able to kind of plug themselves in and not miss a beat.
Yeah. Okay. And do you do that with flooring? Is all that basically the same? If it's the Henry brand, it's all going to kind of have the same kind of updates on kitchen and.
Yep. Yeah, we're moving to we're moving to a kit to where every property has the same kit, and there's no, little to no variation, across anything. So, yeah, but we want everything the same, everything operated the same. We do work with third party management. I know, there's, I don't know, there's some people that argue being vertically integrated's the way to go. I can make an argument, look, if we were vertically integrated, I'd be saying vertical integration.
Right.
But I think we're kind of best of both worlds. I think we're kind of a hybrid approach. So we have a dedicated regional, we have a dedicated accountant. So we're kind of like a small management company within the larger organization. And we work with Asset Living. They're the second largest management company in the country, and they get, because of that, we get preferred pricing on a bunch of stuff. And then also this is a really big benefit, is labor. So anytime we have a position open up, in Houston, Asset has 30,000 plus units. So we get lots of options as far as, labor and all that. So that's very, very helpful. Otherwise it's so hard to get, well, not always, but it can be challenging to get good people.
For sure. Yeah, that is a bit of a challenge. And if you're having to do that, with each property, then you kind of have to go through that trial sometimes by error. Sometimes you luck out and you get the right person, but seems like that allows for a little bit more consistency. And so and tell me a little bit about what you're seeing out in the marketplace now. I mean, how difficult is it to find deals that make sense? And, I guess when's the last, also maybe a follow-up to that would just be when the last property is that you were able to purchase.
Yeah. We've we bought one deal. Our last deal was late summer of last year. So we bought it. I guess I shouldn't say the price and all that on here, but for tax purposes. But yeah, I mean, we felt like we got a good deal on it. Compared to other comps, just most builders, they have one kind of set of plans and then they go build it, a few of them across the metro. So there's another copy that came out, and they were wanting 20,000 a door more than what we paid. So we were happy about that. The guys that owned it, they had owned it for 30 years. We actually had one tenant that has lived there since it was developed, which is kind of cool. So we're excited about that. But yeah, as far as the market and all that, I would say the appetite for deals and all that is leaning towards the newer end of the spectrum. So a lot of kind of Wall Street money, REITs and things like that, who just have a lot of capital to deploy and all that, are buying newer assets because they can buy basically brand new assets below replacement cost right now. And so that's it. Their money's cheap. So that's attractive for them. So that's where most of the competition is. There's not near as many people going after B assets, kind of 1980s assets. So we're pretty interested in that for DFW. But in Houston, we're continuing to go after 90s and 2000s product because we've transacted quite a bit down there. So we get first looks at a lot of stuff that other people probably don't. As far as cap rates and all that, the kind of 90s and newer, mainly 2000 and newer in Houston, we've seen some stuff that's in the upper fours. But I'd say most of the stuff is around 5 or so, but there's been a few kind of upper fours. In DFW, there's usually a little bit of compression between Houston and DFW, so I'd say you see more stuff in the upper fours. So kind of, call it 4.75 to 5, whereas most of the Houston stuff is 5 to 5.25. So there's some activity. I wouldn't say it's, overly crazy or anything like that. A lot of groups that are, kind of that smaller or mid-size, kind of, I'd say we're mid-size, I guess. The ability to put together capital's the challenge there. A lot of our investors are in other people's deals that some of those maybe have not done so well, or capital calls and all that. So we're seeing, a lot of the people that are in. I think it's a great. It's always whenever capital's hard, that's when it's a good time to buy. Like in the middle of COVID was a great time to buy too.
Right.
And so, I think the people that get in will be rewarded. I think we were just awarded a deal a few days ago. And we're looking at, 3-year turnaround. Because we think we're getting a really good deal on it. We own a deal very, very close to it. We own, so we know what comps are and all that, and so we're getting a really good deal on it, good cap rate. But we're planning on selling it probably in the next 2 or 3 years. As soon as the market kind of pops a little bit, we'd sell it. So
Yeah.
That's kind of the market overall. I'd say rents are starting to starting to rebound a little bit. Occupancies are starting to bump up just a little bit, but probably the further we get into summer, you'll see that kind of start to move up a little bit. RealPage has rent growth for Houston at 2.8% this year, and DFW at 1.8% this year.
Yeah. That's interesting. And I mean, it's growing so quick up there, so I guess that's part of the driver on that.
Yeah. We had a broker. So we had probably they're the largest broker in DFW in terms of volume and all, maybe just in terms of the team. But they were saying that they were like, yeah, DFW's the most competitive market in the country, which is kind of been the theme for a while. But one thing I was going to mention, so the big drive, the reason why a lot of these REITs and all those folks are buying right now is they're seeing the potential rent growth the next few years because apartment supply is falling off a cliff right now.
Mm-hmm.
It's been, as you probably know, it's been difficult to buy with higher interest rates, but it's even more difficult to build. And so it's been like apartment supply this year. DFW is 24,000. They were 30,000 or 40,000 plus last year. Houston is 12,000 this year. They were like 25,000 last year. Houston next year is only like 5,000 units delivered, which is, normally they're like at least 20 to 30,000. And then I think the year after, they're only projected like 500 units.
Oh, wow. Okay.
Yeah.
Well, that should bode well. It's just all about finding the deal then, putting
Yeah.
together the capital for it. So
Yep. Yep.
that's awesome. Well, this has been great. I want to just give you an opportunity to tell the audience how they can find out more about you if they'd like to invest.
The best place is probably our website, momentummultifamily.com. You can find me on LinkedIn, Dustin Miles. I think I have a W in there, Dustin W Miles for LinkedIn, or Instagram's great too. So yeah, always happy to chat. Always happy to just get to network and meet people too, or happy to help any way I can. So
Awesome. And what about any advice you might give somebody who's just starting out in their investment journey?
yeah, I mean I'd say the biggest thing is to be patient. I think that you're whether you're putting deals together or you're investing your own money, this is not you know, you're not putting in a few $100 to buy stock. So you're putting in, probably at least 25 or 50,000. Or if you're going to raise money, then, you're talking a lot of money. So, I would just be patient. If you're, starting out, you're trying to, find your way and all that. I think partnering up or hiring a coach is a good thing to do. I know I've kind of used that, same model for, running or swimming or weightlifting. I go find someone who is willing to coach me that I can pay, because they're, I'm using their or borrowing their time or borrowing their knowledge. And so just try to find someone who's already done what I want to do. And so it just speeds up that process.
Yeah. Well, it must be good advice because I didn't mention, but it looked like you've got a sub 5 minute mile that you do. That's
That's a
unbelievable.
goal. So
Okay. Okay. All
yeah,
right.
I better do that soon. I'm getting up there in age. So so
That's awesome.
yeah.
Well, I've got just one other question I ask every guest, and that would just be a book recommendation. It doesn't have to be real estate related, but just something you've read that's been impactful.
Yeah, I we were chatting about that. So I think I'm an audio book guy, and I'm really enjoying Atomic Habits. Just a great book. Very something that you can use in everyday life. And then I'm a big Ryan Holiday fan, so he has Courage is Calling, and he has a bunch of other books too, but big fan of his too.
Yeah, for sure. Well, Dustin, this has been great. I think we'll call it a show. Thank you so much for being on the Wealth Flow.
Yeah, appreciate it. Thank you. Thanks for having me.
Yeah, thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.